Okay, today we're going to look at how we sell cash secure puts. So we get our favorite platform here, Tastytrade, and we're going to go over on how to sell, where you want to sell, what strikes you want to sell, how to manage it, and when to get out of the trade, right? So a couple of things you want to do. Number one rule is based on research. We want to collect premium stocks. Their options expire the most and they lose the most amount of value between 45 days till about 1 day. But where the risk is below 21 days, so we want to manage at 21 days. So in this case, we don't want to sell weeklies. You see this W, we don't want to sell weeklies, we want to sell monthlies, right? And we want to go somewhere around 45 days, right? So in this case, the closest one monthly is at $48, right? So we're in SPY right now. Let's go ahead and switch to, let's say, Google. Google's a pretty good stock, right? We could actually do SPY as well. That's all right. So, but we'll go ahead and let's do SPY because there's more options and it moves more. Right. So we want to be around the 45 days to whenever we put a trade on. So in this case, it's we got 45 days until December 15, which is just around the corner. Where do we want to sell a stock, right? So on Tastytrade, it's going to tell you the expected move. So we have a plus 23% of up or down. $23 up and down on SPY. So that means we could go ahead all the way to 430, or we could go ahead and go all the way down to 390, right? And you see this orange line here tells us on this platform what the expected move is, right? So the expected move is all the way till 388, right? In 48 days, right? So we got some time right now. We want to sell somewhere around 20%, right? 20 delta. So delta is equivalent to the amount of shares, right? So in this case, 20 delta is about 20 shares of SPYs, right? So that's how much risk you have. But it also determines what percentage it's likely to get there, right? So at 0.30, right? Negative 30, that is a 30% chance. So we want to sell somewhere around the 20 delta, right? Unless you want to be aggressively managing, you want to be selling around the 20. You could sell 30 as well, but we'll sell it to 20. So we can see here at 385, right, on SPY, a couple of things we have here. Percentage of pop is which is percentage of profit, which is 83%, right? We have $388 in extrinsic value, meaning that this right here goes down by theta, right? So every day this if the market doesn't go anywhere, this will lose $9.62 a day, right? And percentage of 50%, which is half of the money that we're going to collect, which is $388, which you multiply by 100, because that's a lot. That's 100 shares, right? And that's 89% chance that you will collect somewhere around $180, right? Roughly half of this. So about $180, $190. And then it's going to affect, it's going to max loss is 38,000 if it goes all the way to zero, but we all know that nothing just goes all the way to zero. Nothing just becomes worthless in this world, right? So, but it is going to charge your account $5,776. So it's going to allocate $5,776 on this trade, right? Because it's not just going to let you put trades on if your account can't handle it. So it's got to limit you somehow, right? So that's how it limits. Now, in this case, you can see this green line here and this red line, right? So you actually wouldn't start losing money until $381 if you held this until the end, right? But you can see as long as it stays above 385, you want to get assigned the shares and you'll be good. Now if we go into the curve area, and we could further see this, right? Because we can see that we sold a put here, the market's trading right about here, right? 410, and the market would need to fall a aggressive would fall aggressively before you actually can get there, right? So you could see that the market would need to fall. Oh, again, it's giving me scroll issues, right? It would need to fall a good amount for us to actually have a issue here. And we could go ahead and you can see your delta increases right here when it goes negative, but you could manage this, right? So you might be like, okay, well, if it starts going down, how do I manage this, right? And well, let's take a look at how to manage that, all right? If the market just doesn't go anywhere, right, and it stays here, you can see that the amount the amount for the shares, for the option is just going to go down, right? And now it's $250, and we're at November. We're at even closer, right? We're at 27 days, right? And you can see that 27 days it is already trading at $200, right? So in 27 days, in 20 days, you're collecting $100 guaranteed, right? If the market doesn't go anywhere. And the other way to manage it is whenever it goes closer to this, right, and you start to break even on your amount. Let's say it starts to go down and your profit is disappearing, right? Let's say your profit is at $100, right, because the market moved down and it's $100. Well, what you could do is do the same thing, buy this one back and sell the next 20 delta one, right? So you'd be collecting that $100 and using that to the next one, right? So you could sell the 340, right, the next three delta. If the market moves, and we could go ahead and we could look at this, let's say theoretically, right, spot price. Let's say theoretically at the spot price, right, whenever we go down to $400, right, and we keep going down, right, in time. I'm doing this wrong. Yeah. Oh, that's giving them more time. Yeah. Whenever you see that curve starts to come in, right? Because your risk is smaller, right? And you can see your profit is going up, right? And your percentage of it reaching down there is smaller, so you could collect your money. You could collect your money and then run away. This is exactly what I did this week in Intel. Right, Intel had earnings, and I went to the weekly, and you can see it tells you the IV. The IV was at 110%, meaning that everything else is very expensive. You can see the shares are very not that high in price, but I was able to sell a $32.5 put for $60, and then I bought it the next days because the IV fell down, right, back to 40%. It fell down back to $6 or $6 or $7 an option, right? So I was able to make $50 on the option just by selling it, right? So in this case, even at that money, right, when you look at it, right, even if you were able to buy the shares right now of Intel at the money, it's $68, but I was able to put it a couple of dollars out of the money, and it was actually making me money. And that's how we collected a premium on the Roth IRA this week. We sold some cash secure puts in INTC, and we collected that overnight. And we also sold some cash secure puts as well in Snapchat, believe it or not. We sold some 850 puts, and they were trading for, I think, $40-something, and I bought it back for about $9, right? So we made about $30 per contract there at the 850, right? So whenever you do that, whenever the IV spikes, everything gets more expensive, and you wanna be able to put more positions on, because when volatility and volume IV spikes, you want to be able to collect more premium. So that's how you manage it, right? So we talked about a couple of things, right? If we look at Google, right, same thing. So if I was to sell a cash secure put in Google, right, and I would go to the monthly ones, which is December 15, 48 days out. And I would, whenever it would get to about the 20 days, right, you need to go to the next month. So whenever December 15 comes around as 20 days away, you would go to the next one, which is January 19th, right? You collect another 30 days in that one, and you collect another 30 premium, right? So in this case, you can see Google has less strikes during the one, but you can see that this one has 28 delta and 17 delta. I would probably sell this 17 delta, right? And who wouldn't want to buy Google at $110? It's $122 right now. So you get a massive discount if it does fall. But our goal is to only collect that premium, right? So we're gonna collect that premium at $98, right? If you want to take a little bit more risk and you want to go to 115, sure. But the orange one tells you what the expected move for this month, for this time frame, 48 days out is. So it's expected that it shouldn't drop below about $115. And it should stay around that range, and it shouldn't go above like $138, right? So it could oscillate between there. So that's wonderful for us. We want to sell a 17 delta put, which you can see that it has an 84% of collecting 100% of the money. It has an 88% chance of collecting the 50%, and it's a 17 delta. And every day the contract will be losing $3.7 per day. Your max profit is $98, right? Your max loss is $10,000, but that's if you get assigned the shares and you move down. Your buying power that gets reduced is $3,300. Now you might be like, okay, but if it only loses $3.07 per day, 78 cents per day, that's not a lot of money for you. Yeah, but if the shares go from 122 to 125, you can see that this is a massive drop. Whenever it goes $5 away, right, and it gets dropped to the next one, it loses a lot of money, right? So from $98, if this goes from 122 to $127, this contract right away will be worth about $77 the next day. And plus the losing delta, right? Theta, this contract would be losing a lot of money for whoever bought it, right? We would be making more money. And our goal is to probably collect $45 in this one and just get out, right? That is the goal. And if the market does move down, right? If the market does move down, let's say in this case, the market moves down, and now our $100 10 put is worth $235 put. Now we're in the red a little bit, right? Now we're in the red, and we're in the red by about $150, right? Well, what we can do is buy back this put, and we could sell one further down the road and then collect back, and then our losses would get minimized, and we would be losing only about $20, right? So, or you could go back and do this, and then your losses would be less. But you still got a lot of time on your table. You don't really need to worry about this until you get to about the 21 days. So this is how you sell a put, right? And you make money. You could always buy a protection, right? You could say instead of having to risk that much money, you could also buy one $95 put, right, which is further down, right, just in case. And now your buying efficiency reduces to $1,400, but your max loss is $1,400, and your max profit is $100. So, and now why did it go up? Well, because there's a spread. You can see the spread right here. This is why I wanted to do SPY, because the spread is a little bit, the difference between somebody selling it and somebody buying it, right? So somebody buying it is trying to buy it at $98, and somebody selling it is trying to sell it at $160, right? So in this case, you would actually be trying to fit in the middle, right? So you'd be trying to get this contract for like $120, $130, so you actually be making a lot more money. And that's your percentage of 50% profit, which is like $50, right? Is 90%, right? So if you're collecting 90% of this money, right, on $1,400, right? If we do the calculation on this, 1,400. Let's say you're only able to sell this for $110, right? And then $1,400, that's about 7.8%, right? In theoretically speaking, you'd be targeting in 20 days, right? So 7% in 20 days. And this is why you want to have different underlyings, different strike price, and you could do the same thing to the upside, right? So in this case, you'll be selling the 20 delta call, right? And let's say we're going to go there, and then we're going to buy the 45, and then next thing you know is your max loss doesn't go down, but your max profit now goes up, right? So as long as Google stays between that one, you're making money. And if it doesn't, you just keep moving it out. And that's how you sell a cash secure put, guys. And manage it and make money.